Welcome to our journey into the world of wealth building, where we challenge the conventional wisdom that says, to get rich, you must be an entrepreneur. It's a narrative that's been sold to us through countless success stories, movies, and motivational talks. But what if we told you there's another way? A way that doesn't involve pitching to investors, sleepless nights worrying about your startup, or the roller coaster ride of entrepreneurship. Did you know that the vast majority of millionaires today didn't make their fortunes by starting a business? In fact, a comprehensive study found that most wealthy individuals accumulated their riches through strategic investments, savvy financial planning, and leveraging the power of compound interest. These are paths paved not with the bricks of risk-taking entrepreneurship but with the mortar of patience, knowledge, and disciplined investing. Consider this. The stock market, on average, has returned about 10% annually over the last century. Real estate, another cornerstone of wealth building, has consistently appreciated, offering both rental income and capital gains. And let's not overlook the power of a well-funded retirement account, which benefits from tax advantages to grow your nest egg over time. In this series, we'll debunk the myth that entrepreneurship is the only route to wealth. We'll explore proven strategies for building financial security and growing your wealth over time, without having to come up with the next big tech innovation. From the importance of financial literacy to the power of passive income, we'll cover everything you need to know to embark on your own path to riches. So, if you're ready to discover the secrets to building wealth that many aren't talking about, you're in the right place. Whether you're a seasoned investor, someone looking to make their first investment, or simply curious about alternative paths to financial success, this series will offer valuable insights and practical steps you can take today. Let's break free from the entrepreneurial myth and explore the many roads to riches that lie before us. Welcome aboard. Chapter 1. The Entrepreneurial Myth. Once upon a time, we were all told a story that goes something like this: want to get rich? Start your own business. But let's face it, folks, not every story leads to a pot of gold. In reality, becoming an entrepreneur is akin to embarking on a roller coaster that only a handful are prepared for. It's not just about having a groundbreaking idea or being your own boss. There's a lot more to the entrepreneurial journey than meets the eye. Surprisingly, the path to wealth for many has often been found elsewhere. Now, don't get me wrong. Entrepreneurship has its perks, but it's not the only road to riches. For every successful startup story, there are countless others that didn't quite make it. It's essential to understand that the risks involved are not for everyone. Think about it. For every Mark Zuckerberg, there are thousands of others who faced setbacks that are rarely talked about. The truth is, the entrepreneurial dream can sometimes be a myth. Yes, a myth. It's a tough pill to swallow, especially with the glamorization of startup culture. But consider this: a staggering 90% of startups fail. That's not just a number, it's a reality check. The reasons vary from lack of market need, running out of cash, to not having the right team. These aren't just minor hiccups, they're full-blown roadblocks on the path to success. So, before you dive headfirst into the entrepreneurial pool, ask yourself if you're ready for the swim. It's not just about the potential to get rich, it's about navigating through a maze of challenges with resilience. And guess what? There are other, perhaps more reliable, paths to building wealth. Paths that might not have the allure of entrepreneurship but come with their own set of rewards. Chapter 2. Statistics and Surprises. Did you know that according to the Small Business Administration, (SBA), about 1/3 of businesses fail within the first 2 years? And by the time we hit the 5-year mark, only about half are still standing. These numbers aren't meant to scare you but to highlight the stark realities of starting a business. But here's a thought: while entrepreneurship can indeed lead to significant wealth, it's not the only way. In fact, many have found financial success through more traditional routes. Think about it. Not everyone has the stomach for the highs and lows of entrepreneurship. And that's perfectly okay. Let's talk about surprises. Did you know that many of the world's wealthiest individuals actually accumulated their wealth through investing, real estate, and other avenues? Yes, you heard that right. For instance, Warren Buffett, one of the richest men on the planet, made his fortune not by starting a business from scratch but through savvy investments. Investing offers a more structured, albeit still challenging, path to financial growth. Unlike entrepreneurship, where the success often hinges on a multitude of unpredictable factors, investing allows for a more calculated approach. By understanding the market, diversifying portfolios, and playing the long game, investors can potentially see significant returns. And let's not forget about real estate. It's another powerful vehicle for wealth creation. With the right strategies, such as rental income, flipping houses, or real estate investment trusts, REITs, individuals can build a steady stream of income and capital gains. So, why isn't everyone jumping on these opportunities? Well, like entrepreneurship, investing in real estate come with their own risks and require a certain level of knowledge and patience. However, the key difference lies in the nature of these risks and how they can be managed more systematically. Chapter 3. The Wealth Builders. When we talk about building wealth, it's easy to get caught up in the entrepreneurial hustle. However, the landscape of wealth building is vast and varied. Let's explore some of the most reliable and perhaps underrated avenues that savvy individuals have been using to grow their riches. First up, let's talk about the stock market. It might seem daunting with its ups and downs, but history has shown that it's one of the most effective ways to build wealth over the long term. Investing in the stock market isn't about making quick bucks, it's about being patient, disciplined, and smart. Did you know that the average stock market return over the last 100 years is around 10% annually? This means that, with the power of compound interest, even small, consistent investments can grow into substantial sums over time. Now, navigating the stock market requires some knowledge. It's not just about picking stocks on a whim. Successful investors like Warren Buffett recommend focusing on the fundamentals of a company, such as its financial health, competitive advantage, and market potential. They also stress the importance of diversification to spread out risk. By investing in a mix of stocks, bonds, and other assets, you can weather the market's volatility more effectively. Another intriguing avenue for wealth building is through high-yield savings accounts and certificates of deposit, CDs. While these might not offer the high returns of the stock market or real estate, they come with significantly lower risk. For those just starting out or looking for a safe place to park their emergency fund, these financial instruments can provide a secure, albeit modest, growth of your savings. The key takeaway here is that there's no one-size-fits-all strategy for building wealth. The best approach depends on your financial goals, risk tolerance, and time horizon. Whether it's through the stock market, savings accounts, or other investment vehicles, the important thing is to start. Even small steps can lead to significant wealth over time. Chapter 4. Investing 101. Investing might seem like a game reserved for the financial elite, but it's actually a tool accessible to anyone looking to grow their wealth. The first step to successful investing is understanding the basics. Let's break it down. Investing is essentially the act of putting your money into assets with the expectation of generating a return. This can include stocks, bonds, real estate, or even commodities like gold. The goal is to have your investments grow over time, thereby increasing your wealth. One of the fundamental principles of investing is the risk-return trade-off. Generally, higher-risk investments have the potential for higher returns, while lower-risk investments tend to offer more modest returns. It's crucial to assess your risk tolerance and investment horizon before diving in. Another important concept is diversification. By spreading your investments across different asset classes, you can reduce risk and improve the potential for returns. Think of it as not putting all your eggs in one basket. If one investment performs poorly, others might do well, balancing out your overall portfolio. Let's also touch on the power of compound interest, often hailed as the eighth wonder of the world. It's the process where the interest on your investments earns interest itself, leading to exponential growth over time. The key to harnessing this power is starting early and investing consistently. Lastly, it's important to stay informed and continue learning. The world of investing is constantly evolving, and staying up to date with market trends and financial news can help you make informed decisions. Remember, successful investing isn't about making quick, speculative gains, it's about long-term growth and financial security. Chapter 5. Real Estate Riches. Diving into real estate might sound like a venture reserved for the wealthy, but it's actually a feasible path to riches for many. The beauty of real estate investing lies in its versatility and the variety of ways one can profit from it. From rental income to property appreciation, real estate offers a tangible asset that can provide both steady cash flow and long-term wealth growth. One popular strategy is rental properties. Whether it's a single-family home, a duplex, or a larger apartment complex, owning rental property can generate a consistent monthly income. It's not just about collecting rent, it's about understanding the market, finding the right location, and managing properties effectively. The key here is to ensure your rental income exceeds your expenses, including mortgage payments, taxes, and maintenance, leading to positive cash flow. Another avenue is flipping houses. This involves purchasing underpriced properties, renovating them, and selling them at a profit. While this strategy can offer quick returns, it also requires a keen eye for potential, a good understanding of renovation costs, and the ability to sell efficiently. It's not without risks, but for those with the skills and patience, flipping can be incredibly lucrative. Then there's real estate investment trusts, REITs. which allow you to invest in real estate without owning physical properties. REITs are companies that own, operate, or finance income-producing real estate across a range of sectors. By investing in a REIT, you can earn a share of the income produced through commercial real estate ownership without the need to buy, manage, or finance any properties yourself. This can be a more accessible way to get into real estate investing, especially for beginners. The success in real estate investing comes down to education, due diligence, and a bit of risk tolerance. With the right approach, real estate can be a powerful tool for building wealth over time. Chapter 6: Stock Market Success. The stock market often appears as a daunting realm of unpredictability, but it holds immense potential for wealth building. The key to success in the stock market is not in timing the market, but time in the market. Long-term investing, rather than speculative trading, has been proven time and again to be a more reliable path to accumulating wealth. First, understanding the basics of the stock market is crucial. Stocks represent shares of ownership in a company. When you buy a stock, you're essentially buying a piece of that company's future profits and growth. Over time, as the company grows, so does your investment. However, this growth is not linear or guaranteed, which is where diversification becomes essential. Diversification involves spreading your investments across various sectors and asset classes to reduce risk. A well-diversified portfolio can help you weather the inevitable ups and downs of the market. This is where mutual funds and exchange-traded funds, ETFs, come into play. These funds pool money from many investors to buy a wide array of stocks or bonds, offering instant diversification. Another important concept is dollar-cost averaging. This strategy involves regularly investing a fixed amount of money, regardless of the market's condition. Over time, this can lower the average cost of your investments and potentially increase your returns, as it mitigates the impact of market volatility. It's also vital to have a clear investment strategy and stick to it. Whether it's focusing on growth stocks, value stocks, or dividends, consistency and patience are key. Remember, the stock market is not a get-rich-quick scheme but a tool for steady, long-term wealth accumulation. Chapter 7: Retirement Accounts. Retirement accounts might not sound as glamorous as flipping real estate or trading stocks, but they're a cornerstone of wealth building. These accounts offer tax advantages that can significantly enhance your ability to accumulate wealth over time. Let's delve into how leveraging retirement accounts can be a savvy strategy for long-term financial growth. First, consider the traditional 401k and IRA accounts. Contributions to these accounts are made with pre-tax dollars, which can lower your taxable income. This means you're effectively investing more of your money up front. Over time, the power of compound interest works its magic, allowing your investments to grow tax-deferred until retirement. When you start withdrawing funds in retirement, you'll pay taxes on the withdrawals, ideally at a lower tax rate. Then there's the Roth IRA and Roth 401k. These accounts take a different approach. You contribute after tax dollars, but the beauty lies in the withdrawals. When you retire, you can withdraw your contributions and earnings tax-free. This can be particularly advantageous if you expect to be in a higher tax bracket in the future or if tax rates rise. One of the most compelling reasons to invest in retirement accounts is the potential for employer matching in 401ks. Many employers will match your contributions up to a certain percentage, which is essentially free money and an immediate return on your investment. Not taking full advantage of this is leaving money on the table. Another benefit is the power of automatic contributions. By setting up automatic transfers to your retirement accounts, you're practicing a form of paying yourself first. This not only enforces discipline in saving and investing but also takes advantage of dollar-cost averaging, reducing the impact of market volatility on your investments. Lastly, retirement accounts offer a variety of investment options, from individual stocks and bonds to mutual funds and ETFs, allowing you to diversify your portfolio according to your risk tolerance and investment goals.